The coming collapse of cryptocurrency. I'm going to reveal some shocking warning signs that we have seen recently that show us how the entire system, the entire network could come crashing down. If you're invested in cryptocurrency, or if you're an investor in general, you have to understand what's going on with the cryptocurrency market right now. Your financial future could depend on it. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over stable coins and how they work, or what I like to call unstable coins. A much more appropriate term. I'll show you guys why in just a moment. We're going to start off with my good buddy here, Rick Rule. And Rick, I apologize if you're watching. I didn't have much time to figure out how to draw you, buddy, so that took about 30 seconds. But Rick has or had a gold fund. I think Rick recently retired. But we'll assume this gold fund, XYZ, is the Sprott fund. I believe the ticker is PHYS. And they're a fund or a trust where they hold gold as the underlying asset. Here's how this works. The average Joe wants some exposure to gold, but he doesn't really want to store it and go through all the hassle. So he gives the XYZ fund or the Sprott fund his money, and the fund takes Joe's money, goes out and buys an equivalent amount of gold from this guy who's just taken a shovel and found some gold out in the woods somewhere. We'll call him Miner Mike. So Miner Mike is mining the gold, and the fund buys the gold from Mike, and then the gold becomes an asset on their balance sheet. Now, in return for the money that Joe gave the fund issues Joe shares. So what happens is the shares go up and down in price with the underlying asset, the net asset value, or you hear that a term called NAV all the time. And this is very important. We're going to get to this in a moment because that's when market maker Mark, I'm using a lot of M's today, really plays a big role in the marketplace for these shares. And this is why the shares trade right around the value of the underlying asset themselves, in this case, gold. So pretty straightforward, not rocket science. But how do these stable coins work? What we're going to do is focus on the largest stable coin or unstable coin by far. This is called Tether. So it's very straightforward. Your friend and family member Fred wants to get rich. So he wants to trade Dogecoin and Elon Musk's new coin and Dave Portnoy's new coin because it's going to go to the moon, and that's how he's going to buy that Lamborghini or rent that Lamborghini that he can post on Instagram. So to do so, it's much more convenient to trade cryptocurrencies using Tether than it is the dollar. So Tether's claim to fame is that you can just buy these Tethers and they're a 1-to-1 relationship with the dollar. So your friend and family member Fred gives Tether Inc., we'll call it, the dollars, and then Tether Inc. issues your friend and family member Fred the Tethers. Those dollars go onto the asset side of Tether's balance sheet. Pretty straightforward. And what most people believe is that they can take those Tethers at any time and just give them back to Tether Inc., and they'll go ahead and give them the original dollars. Pretty straightforward. But unfortunately, this isn't even close to how it actually works. So the first thing I'd like to point out is the underlying asset is owed to the individual that owns the shares or the Tethers. So we've got to analyze the underlying asset itself. Now, there is some counterparty risk with a gold fund as an example, because you have a custodian who is actually holding the gold or storing it that is reflected by these outstanding shares that are trading in the market that the fund issues to go up and down with the price of gold itself, or to be a proxy for gold. That's a counterparty. But when you look at the asset itself, there is no counterparty risk with gold. It is payment in and of itself. To a certain extent, it's the same thing with dollars. There really isn't a counterparty risk with dollars, excluding inflation and everything else. But it is kind of payment in and of itself. But that's if Tether was holding the dollars that most people believe they have as an asset on their balance sheet, backing up all the tethers they sold to your friend and family member Fred to go into the cryptocurrency market, create demand and liquidity. More on that in a moment. But a lot of this has to do with faith. In the case of Joe, he believes he can take these shares and redeem them for gold. In the case of your friend and family member Fred, he believes that he can take his tethers and redeem them for US dollars. But once we peel back the layers of the onion, we find out that this may or may not be true. Editor, let's go right to the internet. Let's go ahead and start off by going to Tether's website and looking at their terms of service to see what the restrictions are around redeeming your tethers for dollars, and also get some insights on what's actually on their balance sheet that is the equivalent, so they say, of actual dollars, cash. So about their tokens, general restrictions: Tether issues and redeems Tether tokens. Okay, we got that. Tether tokens may be used, kept, or exchanged online wherever parties are willing to accept the Tether tokens. Pretty straightforward. Tether tokens are 100% backed by Tether's reserves. I didn't even notice this, but they've got a typo there. Tether, if you're watching, you've got a typo on your terms of service. I think Tether's tokens are 100% backed by Tether's reserves. Okay. But my main point is, what are these reserves? Because people just think that it's cash, that it's dollars. Tether tokens are denominated in a range of fiat. Okay, so they do euros, dollars, etc. Okay. The composition of the reserves used to back Tether tokens is within the sole control and at the sole and absolute discretion of Tether. So now we're starting to get the idea that there might not be dollars that actually back up those tethers. And that leads us to the question of how redeemable are they? Okay, let's keep going. Tether tokens are backed by Tether's reserves, including fiat, but Tether tokens are not fiat themselves. Okay, Tether will not issue Tether tokens for consideration consisting of digital tokens. Only money will be accepted upon issuance. And I find that very interesting, that you can't actually use crypto, as an example, Bitcoin, to buy Tether from Tether. They only take money. Okay. In order to cause Tether tokens to be issued or redeemed directly by Tether, you must be a verified customer of Tether. So how do you become a verified customer of Tether? And isn't that also at their sole discretion? So if they said, okay, listen, you've got $1 million worth of Tether that you want to redeem for dollars, you've got to go through this verification process. And you go through that process and they say, yeah, it's not going to happen. We're not going to verify you. For whatever reason, they can just keep kicking that can down the road. This gives them the legal right to do that. And meanwhile, you're just sitting there holding the bag of tethers and not having access to your $1 million worth of currency. And here's the part we really need to pay attention to. Tether reserves the right to delay the redemption or withdrawal of Tether tokens if such delay is necessitated by the illiquidity or unavailability or loss of any reserves held by Tether to back the Tether tokens. And Tether reserves the right to redeem Tether tokens by in-kind redemptions of securities and other assets held in the reserves. So what they're saying is if they take your dollars and go out and instead of holding those dollars as assets on their balance sheet, which I would imagine 90% of the people that hold Tether assume they're doing, they're going to take those dollars and they're going to go out and buy corporate debt. They're going to buy shares in Tesla. Who knows? They may buy Dogecoin. They may buy Dave Portnoy's new coin. To the moon, I think is what he's calling it. And you have no control over that whatsoever. And then what they're saying is if Dogecoin goes down by 50%, or if they can't sell it at a price they need to get, then they're just going to delay paying you. And that's if you're a verified customer. Or they say if there's no availability of the asset, or if they take a huge loss on the asset, let's say they take in $100 million, they issue 100 tethers, 100 million tethers, and then the value of those assets go down to 10 million. Well, they don't have that other $90 million to give you. And you may be saying to yourself, okay, George, it sounds a lot like fractional reserve banking. In a way. And we're going to get into that in a moment. And then I think this is fascinating right here at the end, where they say that they can actually make redemptions using the securities they have as assets. So if I'm reading this correctly, if they buy a corporate bond for $100,000, and that's how they're marking it on their balance sheet. See, it's not marked to market. What they're doing is when they buy it, whatever the retail value or whatever the price they paid for the asset, that's what's going on to their balance sheet. So if it goes down by half, they're still claiming that it's worth what they paid for it. So if you came to them with a redemption for $100,000, they could give you those corporate bonds that they paid $100,000 for, but are now worth $50,000, let's say. The bottom line is on their website, they say that these tethers are redeemable per terms of service. And my guess is very few people are actually reading the terms of service. Because if they did, I don't think they would be holding on to Tether long term. That's for sure. So whether or not your friend and family member Fred can get his dollars back for the tethers he purchased originally is definitely up in the air. But I know a lot of you have some pushback there, and they say, George, it's a lot like fractional reserve banking. Or you may point out the fact that a lot of gold funds, not necessarily Rick's fund, but the GLD as an example, you can't redeem your GLD shares for gold. So they would say, okay, well, George, even if you can't redeem your tethers for dollars, there's a lot of funds that exist out there that operate in the same manner. But you need to think that one through. It goes back to market maker Mark. What is his job? Sometimes we can see a scenario where there's tremendous demand for the shares themselves. That drives the price higher because remember, these shares are traded on the open market. And the value of the outstanding shares can actually exceed the NAV, the net asset value. In this case, the value of the gold, the underlying asset. And then the opposite is true. Sometimes there's very little demand and the shares can fall under the price of NAV on the open market. But see, that's where market maker Mark comes into the game. If the shares go up in price and exceed the NAV, he can come in, buy gold from miner Mark, and then throw those onto the asset side of the fund's balance sheet. They give him shares. He can sell those shares into the market at a higher price than he paid for the gold and then pocket the spread. And the more shares he sells into the market, the more supply, that brings the price down to where it's closer or right at the value of the underlying asset. And the opposite is true. If these shares go too low, then market maker Mark can come in and buy those shares, and then he can redeem those shares for gold. He takes supply out of the market. He pockets the spread because he's buying them at a lower price than the gold he is getting from the fund when he redeems it. And then that brings the share price back up. But there's no market maker down here for Tether. Your friend and family member Fred is the market maker. Therefore, if he can't redeem the Tethers for cash like market maker Mark can, then there's nothing to really regulate the price and there's nothing to really keep that peg other than Tether issuing more shares, or in this case, Tethers, or Tether buying back those outstanding coins if the price goes below the dollar, if the peg is broken. But in order to do that, they'd have to have the dollars to buy back the excess supply of Tethers. And if they're not holding dollars on their balance sheet and they're holding something far riskier, you see how this could be a huge, huge problem. Now let's address the issue of Tether being very similar to a bank. They use fractional reserve banking. So Tether is saying that they've got all of the assets to match up with the Tethers. They're not claiming that they're fractional reserve, but a lot of people are saying that they don't have enough of the, let's say, dollars to match the Tethers. So if there's $1 billion of Tethers outstanding because they've never been audited, people are saying, well, shoot, they could have $10 million worth of assets and no one would ever know. And then again, the rebuttal is, well, that's exactly what fractional reserve banking does. And we've been using them for quite some time. But I'd like to point out that it's very different from the standpoint of you have access to your dollars. If you go down to the bank, it might take you some time, but you can get that cash. You can transfer that to another bank. And per their terms of service, that is an unknown, to say the least, with Tether. Also, the bank can cover some of their loan losses with equity that they have. And then finally, we know this from past experience, and I'm not saying this is a good thing, but you know darn well, most of those banks are going to get bailed out if they run into problems. And we've got the FDIC insuring accounts up to $250,000. Now, that's another issue as well, because the FDIC is pretty much insolvent if we had a big problem, because they've got about $150 billion insuring over $10 trillion in deposits. And that's by no means a fail-safe, but the government would most likely come and bail out the FDIC as well. What's my point? So I can promise you one thing, the government is not going to come in and bail out Tether if they run into the same problems. Now, you may be scratching your head and saying, okay, George, I kind of get it, but I mean, Tether isn't all of cryptocurrency. So although they may have some problems, how does that affect Dogecoin? Or how does that affect Dave Portnoy's new coin? And what you have to understand is Tether provides a massive amount of liquidity to the overall market. So if Tether goes down, the whole entire house of cards could come crashing down as well. And we're going to talk about Bitcoin and Ethereum and see if they could take a hit to the price as a result of Tether as well. More on that in step number 3. Step number 2. Now let's dive into the balance sheet of Tether, or the insane BS. I'll let you decide whether you want to call it the balance sheet or BS when we get done with this step. But I want to do this so we can understand what's going on with Tether and how it may trigger a collapse of the entire cryptocurrency market. So going back to step number 1, we had your friend and family member Fred that gave his dollars to Tether. They gave your friend and family member Fred those Tether coins that he can use to trade on Bitcoin exchanges in or mostly outside of the United States. There's kind of a gray market that we're going to get into in just a moment. And your friend and family member Fred thinks that Tether has those dollars on their balance sheet, and if he wants to trade, he can go ahead and swap out and get his dollars back. But let's look at what Tether actually does with those dollars when they get them from your friend and family member Fred. This has been kind of in the shadows for a long time. No one really knew what they were doing behind the scenes. But recently, they have come out and disclosed what their balance sheet actually looks like. Here's the overview. 75% is cash or, my favorite, cash equivalents. A lot of wiggle room there, to say the least. 12.5%, we have secured loans. And that's another very ambiguous term. Secured by what is I think, a better question. Then 9.9% would be corporate bonds. And they actually, I didn't put it up there, but they've got some precious metals. They actually have gold as well, which normally you would like to see. But in this case, when the redemption is in dollars, gold might not be that good of an idea. And I'll explain that more in just a moment. And then 1.6% of the balance sheet is actually cryptocurrency. So they could own a Doji coin, or they could own Portnoy coin, or whatever the hell he's calling it. And this just gives you a brief glimpse at how this quote unquote stable coin is extremely unstable, because there's a 1-to-1 peg with Tethers and the dollar. But if the underlying assets are not dollars and they can go up and down in price in dollar terms, that puts us into a position where Tether Inc. could be completely insolvent very, very quickly. But now that we understand 75% of their balance sheet is cash and cash equivalent, let's dive into that a little deeper and see what constitutes this 75%. And this is where you're really going to need to sit down and pour yourself that stiff drink. It is definitely stiff drink time if you own Tethers, that's for sure. So 65% of this is commercial paper. Okay, well, that's corporate debt. What happens if that corporation goes under and they can't deliver on the promise to pay you back the money? Well, now all of a sudden they have a heck of a lot less dollars than the outstanding Tethers. You see where this is going? Next one, fiduciary deposits. That could be hedge funds. Who knows? Then like 3.8, or it's either 3.6 or 3.8% of the entire fund is actual cash, not 100%. And who knows? They didn't even say it was dollars. It could be yen, it could be euros, it could be something that can go up or down in value relative to what your friend and family member Fred thinks he has, or thinks he has a peg to with his crypto tokens. Now, this is where it goes from weird to flat out bizarre and horrifying. 3.8%, or a certain percentage, it was either 3.8 or 3.6%, they put into the reverse repo market. The repo market. So Tether is providing liquidity to counterparties in repo. And you guys know from watching my videos how safe, secure, and stable the repo market is. Obviously, I'm joking. Hopefully you got my sarcasm right there. But that's the absolute last place that you would think a fiduciary that was behaving responsibly with their balance sheet that had dollar liabilities would actually take those dollars and gamble them in the casino known as Wall Street with these other banks, hedge funds, financial institutions, and maybe even the Fed. Who knows who they're doing reverse repos with. And let's remember what a reverse repo is. That's when Tether takes your money and lends it to a hedge fund that gives them treasuries or mortgage-backed securities as collateral. And then they swap back in 2 weeks or 2 months. So Tether could be taking your money and buying mortgage-backed securities with it. That's the bottom line. The same mortgage-backed securities that blew up in 2008. In addition to that, they've got corporate bonds. They've got commercial paper that could go up or down in value. They've got secured loans. And to make it even more insane, they've even got cryptocurrency, which itself is wildly volatile. I think one of the main takeaways all of you watching need to get from this step, regardless of whether you're in crypto or not, is there's no free lunch. Why do people use Tether? Because it's cheap. The transaction costs are very, very, very low. If they were taking dollars and exchanging them for crypto or to go into their account, every time they went back and forth, they'd be charged maybe 1% or 2%. But with Tether, it's maybe 1 or 2 basis points. So your friend and family member Fred thinks that he's getting super cheap transactions, and that's a benefit to him. But what he doesn't realize is he is paying a much, much higher price for those transactions by taking on additional risk, massive amounts of risk that he isn't even aware of. To illustrate the underlying problems with this strategy, even better, let's go right to the internet. Let's start by going to an article from Bloomberg that highlights the instability of the stablecoin Tether. They start off by telling a story of Lehman Brothers, which is appropriate. On September 16th, 2008, the day after Lehman Brothers filed for bankruptcy, the reserve primary fund broke the buck. Its net asset value fell below $1 per share. The fund, often called the first money market fund, held $785 million of Lehman commercial paper that was suddenly worthless. Although the paper represented only 1.2% of the fund's total assets of $64.8 billion, demands for withdrawals escalated, and the fund lost 2/3 of its assets in just 24 hours. This triggered a general run on money market funds that was stopped only when the U.S. Treasury issued an extraordinary guarantee of essentially all money market fund liabilities. So basically what this is saying is when the market senses they could have a loss, that $1 that they have, or that claim on $1, they're only going to get 90 cents or 85 cents. There's going to be a run. Everyone is going to frantically redeem those claims they have, or they're going to extract their money from the fund, in which case the fund might not have the liquidity. They can't pay them. And if they can't pay them, it's just like a bank run. Same thing. The bank goes bust. The article goes to point out that the same thing could very well happen to Tether because of the construction of the balance sheet that we are talking about on the whiteboard. If some of Tether's investments were to become worthless or decline in value, it would suffer the equivalent fate of breaking the buck. Said another way, it would suffer the same fate that Lehman Brothers suffered back in 2008. And if for any reason a wave of Tether holders suddenly tried to convert their tokens to cash, we don't know whether Tether could liquidate sufficient investments quickly to satisfy the demand. See, liquidity is a really, really big deal that is underestimated by the average investor. And what's important to note is Tether provides a lot of the liquidity for the entire crypto market. So if you take away Tether, you potentially take away the liquidity. If you take away the liquidity, the price of the crypto market, or the price of individual cryptos, collapses. The consequences of such an inability to meet a sudden wave of withdrawals could be significant in the larger crypto ecosystem. Tether is the most widely traded cryptocurrency. Its recent volume has been more than twice that of Bitcoin. CoinDesk recently described Tether as a piece of plumbing for the roughly $2 trillion global crypto market. Because traders use it to quickly transfer dollar value between exchanges to capture arbitrage opportunities when a bank wire is unavailable or too slow. A JP Morgan research report earlier this year said that 50 to 60% of all Bitcoin trades are for Tether, and that trading is dominated by proprietary trading firms using high-frequency algorithmic strategies. If those algorithms were turned off, as has happened in treasuries and other asset classes when volatility increases, there could be a significant drop in liquidity. A sudden loss of confidence in Tether would likely generate a severe liquidity shock to Bitcoin markets and to all cryptocurrency markets. Step number 3, the cryptocurrency doom loop endgame. And yes, that's as hyperbolic as I can possibly make a title. But I think you'll see there's reason for my concern and for me going maybe a little over the top with the title. But check this out. We've got your friend and family member Fred. If he were to go directly into the crypto market with, let's say, $1,000 and buy some Dogecoin because he just read Elon Musk's most recent tweet. And boy, oh boy, if Elon Musk is bullish, then your friend and family member Fred is definitely going to buy because he definitely drinks the Elon Musk Kool-Aid, or basically whatever is hot, where he thinks he can get rich really fast. So again, if he goes into the crypto market and buys $1,000 worth of Dogecoin, let's say that drives the price of Dogecoin up to $10. And I know it's not trading anywhere close to $10. I'm just using these round numbers just to illustrate the example. So my point is that your friend and family member Fred has created $1,000 of additional demand, and that drives the price up, all things being equal. But what would happen if you gave your friend and family member Fred $10,000, not of little green pieces of paper or dollar-denominated commercial bank liabilities, but $10,000 worth of purchasing power? Let's say in the form of a digital token. Well, your friend and family member Fred is going to take that additional purchasing power, go into the crypto market, create more demand, a lot more demand for Dogecoin, and that could drive the price from $10, let's say just hypothetically, up to $100. So pretty straightforward. The more purchasing power your friend and family member Fred has, regardless of whether it's real purchasing power or artificial, fabricated purchasing power, as long as he's got more, that means more demand, supply demand, That means price goes up. So now let's get back into what's happening right now in the crypto space with some of these exchanges and Tether, the unstable coin we've been talking about in step 1 and 2. So a lot of the individuals that run Tether Inc. also run an exchange. We'll call it the Tether Exchange. So what they do to entice your friend and family member Fred to come trade on their exchange instead of maybe a Coinbase here in the United States is they'll say, listen, we offer all of these promotions where we give you free Tether. So let's say you invite a friend or you trade with a certain amount of volume. We'll go ahead and give you 500 Tether for free. And those 500 Tether have the same purchasing power right now as dollars. Therefore, your friend and family member Fred can buy more cryptocurrency or more Dogecoin than he otherwise would have been able to buy. But in addition to that, oh, but wait, there's more. I should say, it gets even better. Because not only do you get free Tether through some sort of promotion, but you can also trade cryptocurrency on 100x leverage. Let me say that again, because I researched this extensively yesterday and I could not believe it was true. But yes, there are a lot of exchanges out there in kind of what's called the gray market that will allow you to buy cryptocurrency using 100x leverage. So why not? I mean, you're getting free Tether. Why wouldn't you lever up 100 times because you're playing with the house's money? Now, there's some people that have been very vocal in the media that claim that Tether is issuing a greater number of Tethers than they have dollar equivalents to back up those Tethers on their balance sheet. So what we talked about in steps 1 and 2 are some of the additional risks that most people don't realize, but that's what Tether is telling us. It's very straightforward, and there's nothing illegal to what they're actually doing right now. But this takes it to a whole new level where obviously it would be illegal. If they're only taking in $1, but they're issuing 3 Tethers, then that would definitely be a blatant scam. And I'm not saying they're doing that, but I am saying that there's a lot of people in the media that are making that claim. So let's think this through. If Tether is issuing Tethers just out of thin air that aren't backed by dollars, that is giving your friend and family member Fred a lot more artificial purchasing power, which would drive up the price of those cryptocurrencies that he was wanting to buy, such as Dogecoin. So then what happens, which is very bizarre, is in order to cash out with the dollars, he would have to take those Dogecoin, go back to Coinbase and actually cash out. So I'm sure a lot of you right now that don't have any experience with these crypto exchanges are kind of scratching your head and saying, wait a minute, how are people looking at this and just shrugging their shoulders and saying, no problemo. And you can see the people at the exchange just telling the media, oh, move on. There's nothing to see here. Nothing to see here at all. But to anyone that has some common sense, they look at this and say, this is a complete house of cards. But why would Tether want the price of crypto to go up? Why would that benefit them? Well, let's think this through. If the price of crypto goes up and Tether is one of the main components for liquidity, that means there's more demand for Tethers, more dollars going onto their balance sheet. And they can take those dollars and go into the repo market and get a significant return. So the more dollars they have, the more money they're making in repo or with corporate debt or with secured loans or buying Dogecoin themselves. You see, it becomes very incestuous, and it's kind of comes full circle where they're investing, and I know it's not a large part of their balance sheet, but they're buying the cryptocurrency that, if those skeptics are correct, they are driving up the price artificially by creating more tethers, more purchasing power than really exists in real life. Now, to dive into this further, to make sure you're getting your head around everything, let's go right back to the internet. Let's start by going to a blog post from one of those skeptics I was referring to. And the title is The Bit Short. Obviously, they're playing off the movie The Big Short. Inside Crypto's Doomsday Machine. And what I want to highlight about this article, it's extremely long, or this blog post, is a story that this individual tells about their friend who, he uses the name Bob. Obviously, that's not his real name, but it really illustrates exactly what we're discussing on the whiteboard. So he calls this his epiphany. I was catching up with my friend Bob, pseudonym, over a video chat. I had just sold my Bitcoin position and was nervously awaiting confirmation from my bank that my USD wire transfer out of the exchange had cleared. Crypto was on my mind, so I asked Bob about it. The conversation went something like this. Me: you don't own any crypto, do you? I'm concerned that some of the exchanges in the ecosystem might be fraudulent. Bob: I actually have a whole bunch of crypto on this exchange called Bybit. Do you know if that's one of the risky ones? I'm not sure. Does it let you trade in United States dollars? No, but a lot of other exchanges don't either. In fact, you can't even deposit USD directly into a Bybit account. And I have not verified this, just FYI. I'm just going over what they're saying in the blog post. Really? But then how do you get your money onto their exchange at all if they don't accept USD deposits? You send your USD to Coinbase and buy Bitcoin with it. Then you move your Bitcoin onto Bybit and trade with it there. So now the guy's kind of scratching his head and he says, well, wait a minute, hang on. If that's the case, then why would anybody ever use an unbanked offshore exchange that trades purely in crypto? What does Bybit offer you that Coinbase doesn't? Bob, he says, leverage. I personally, obviously Bob is very conservative. I personally only use 2 to 3 times leverage. But they let you leverage your positions up to 100 times if you want. You can't do that on Coinbase. And you can see this guy gasps. Then Bob continues. They also do a ton of promotions. They've got a bunch of timed missions where you can earn tethers for doing stuff like inviting friends onto the exchange, joining their Telegram group, or trading on their platform. And remember what we said before, one of the big controversies is the question, are they just issuing these tethers or are there assets to really back them up? So Bob continues, but thanks for the warning. I'll pull my crypto out as quick as I can. It might take me a few minutes. I'll need to fire up my VPN first. And then this guy says, a VPN? But why? Because I need to spoof a Bolivian ISP to access the exchange. They're illegal to use if you're based in the US. And I don't know if it's still that way with this particular exchange, but I did a live stream on this yesterday, and a lot of people on my live stream said it is true that for a lot of these exchanges, you have to have some sort of VPN to make it look like you're accessing it from another country. So if this is actually happening, and if Tether is creating excess demand and liquidity in the cryptocurrency market by issuing more tethers than they have assets to back up, you can see how this could take us straight into a doom loop, an epic doom loop, to borrow a term from my good buddy Raoul Paul over at Real Vision. I usually say a doom vortex, which is just a play on his doom loop, but I got to give him all the credit for thinking of that one in the first place. But I think a doom loop describes what's going on here even better than my very own doom vortex. So, what happens if crypto goes down in general for an extended period of time? Well, this would lead to redemptions. I'd also like to add that if the assets held on their balance sheet go down by a significant degree for a long period of time, same thing. It triggers the redemptions we talked about in step number 2 in that Bloomberg article. Well, if there are a lot of redemptions, especially if they have a hard time and they're giving people kind of the runaround and they're making it hard for them to get their dollars, this creates fewer tethers in the cryptocurrency ecosystem, which now is providing a tremendous amount of liquidity at the very least, and potentially could be creating a lot of artificial demand, driving prices higher than they otherwise would be. So if we have a decrease in tethers, we have a decrease in the liquidity and the demand, which drives the price of crypto down even further, which creates more redemptions, which creates fewer tether. And you can see how this doom loop just feeds on itself, driving prices lower and lower and lower. And remember, it takes us right back to what we talked about at the beginning of the step, is if this price of Dogecoin was driven up by access to artificial demand through an increasing amount of tethers that aren't backed up by the underlying assets on their balance sheet, then once you take those tethers out of the system, the price goes from 100 all the way back down to 10, or potentially even lower. But I think the question on everyone's mind right about now isn't really about Dogecoin or Portnoy coin or any of these other thousands and thousands of, we'll call them S coins to keep it family friendly. But it's really about Bitcoin. Is this, if this is really what's happening, what I've outlined here, and what several skeptics have been talking about online, or even what we talked about in step number 2, which is very above board, it's straightforward, very legal, but still adds a significant component of risk to the outstanding tethers. Does this really affect the price of Bitcoin? That's what's on everyone's mind. And I don't know the market well enough to even give you an answer. Remember, it's always about probabilities. It's not about certainties. But if Tether goes down, I can't believe that that wouldn't affect the price of Bitcoin, maybe just temporarily. But I'm here to say that I hope that it would affect the price of Bitcoin, because if Tether goes down, and let's just say as a result, the price of Bitcoin goes down by 20% as a result, I think that would be a great buying opportunity. Because you see, long term, I'm very bullish on Bitcoin, but it never goes up in a straight line. Nothing ever does. And what we want to do, if we're prudent investors, is we want to sell when there is hysteria in the market or in the asset, regardless of what that asset is. And we want to buy when there's panic. Right now, with Bitcoin, even though it's come down, there's a lot more hysteria than there is panic. But if you have a long-term view that Bitcoin's going to continue to appreciate in value due to a depreciating US dollar, then you would want to see panic. You'd want to see the price go down as a result of an unstable coin, because that would give you the chance to get in there and take advantage of the panic that was being felt throughout the market, which was leading to all of those people selling at any price. So the main takeaways here are make sure whatever asset you're investing in, you understand the risks very, very well. And always use people's emotion to your advantage and have a long-term view. Regardless of whether it's cryptocurrency, commodities, stocks, bonds, it doesn't matter. The same strategy that you use to buy uranium or shares in Apple is the same strategy you should use when you're buying Bitcoin or Dogecoin. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.